a significant change has been brought in as far as the taxation for mutual funds are concerned. This was passed through the Finance Bill 2023. The change is extremely significant for certain category of mutual fund schemes. Now, what is the change? What the tax norms are now saying is that any mutual fund scheme which has less than 35% of its portfolio in domestic equity shares, they will lose the indexation benefit when capital gain tax is calculated. Indexation benefit was relating to what is called as long-term capital gain in certain category of funds. The most important category of fund which has been impacted with this amendment is debt funds, because one of the highlights of debt funds has always been that apart from many other features, it gave the indexation benefit. Now, what is this benefit that we are going to lose because of this amendment, right? So let's try and understand that. So before the amendment has been brought in, what used to happen in the income tax was, if you invest in a fixed income mutual fund, which essentially means that they have invested in all fixed income securities in their portfolio, they will essentially earn some rate of return which is linked to the market yields, etc. So in my example, what I'm assuming is, let's say there is a 1 crore investment you made in a fixed income fund before this amendment was made, and 7%, let's say, is the rate of return that you earn from this portfolio over a period of 3 years. So the rate of return kept on compounding, and this 1 crore is now 1.22 odd crores, right? So you made a gain of almost 22,50,000 over a period of 3 years. Now, how was this taxed? So the gain was that much. However, the investment that you made of 1 crore used to get indexed. In other words, the income tax authorities and the law said, we understand that the investment you made was 3 years back. There has been a change in time value of money due to inflation. So we will not consider your original cost as 1 crore. We will adjust it for inflation. So there is something called cost inflation index. We will use that, which is connected to the country level inflation data, and we will increase your cost for calculation of tax purpose. So this 1 crore will get indexed to a more relevant time value figure, which in my calculation, I've considered 6% as an example. So this 1 crore, we will keep on increasing it by 6% because that's the inflation, let's say, becomes 1 crore 19 lakhs odd. So because of indexation, your cost is not 1 crore now, it is 1 crore 19 lakhs, and your redemption value is still 1 crore 22 lakhs. So now in this example, you have a gain of approximately 3 lakh 40, which is taxable. So this 3 lakh 40 is called as long-term capital gain because you held it for 3 years or above. And only in long-term capital gain, you get the indexation benefit, or you used to as we speak. Now on this 3 lakh 40, you actually end up paying a tax of 20%. So even this is critical because not only was indexation benefit available, the tax rate was fixed at 20%, irrespective of your slab. You have something called income tax slabs. You could be at different tax slab rates, right? 10%, 20%, etc. We don't consider all that for long-term capital gain. We will say, you know what, 20% is your tax rate. So on 3 lakh 40, you pay about 68,000 tax. Remember, your gain was 22 lakhs plus, but now the tax is only 68,000. And if you calculate the IRR, it is close to 7% compounded rate of return, which means if you see the impact of tax is negligible now. You held it for 3 years, your tax is almost nothing, 68,000 on a gain of 22 lakh odd. So your effective yield is still 7. This is now no longer applicable going forward from 1st April 2023. And that is why it is a significant impact. So now what will happen from 1st April is all the mutual funds which has been affected by this amendment is as good as going to be treated that they're going to give you interest income, which means you are going to see the taxation of these kind of debt mutual funds and other categories as if they're giving you income which is fully taxable. And that's why a lot has been said about, oh, this is as good as now FD, because in FD, fixed deposit, whatever interest you're going to earn is getting taxed at your slab rate. In other words, what they've said is it is now short-term capital gain from debt mutual funds, which means no indexation. So how will the taxation work now? Same 1 crore investment earning you 7% becomes 1 crore 22 lakhs odd. The gain is 22 lakh 50. Same calculation. However, there is no indexation benefit. Your cost is not going to be adjusted for inflation. The entire 22 lakh 50 is taxable at your slab rate. So if you are at 10% slab rate, you will pay 10% tax on this. In my example, I'm assuming 30% slab rate. You will end up paying a tax of 6,75,000 odd in this example. So the post-tax yield is now only about 5% because you ended up paying tax. So you can see the difference on the returns because of the change in norms which has come in. So it's a very critical impact, especially when you're trying to earn something like 7-8%. A 2% difference in yield is very, very significant. So now whether you are investing in fixed deposit or a debt mutual fund, from a taxation point of view, the impact is the same now. Now, what other categories have been impacted? Because the amendment did not say debt mutual fund. They said any mutual fund which has less than 35% exposure to Indian equity. So there are other categories also which are getting affected. As you can see here, all debt funds will get affected, as I just explained. Importantly, your gold funds will also get affected because gold funds or gold ETFs invest in gold, which is not domestic equity. They will also now lose the indexation benefit they used to get. It will be fully taxed at your slab rate. It kind of pretty much kills that category now. There is no sense of investing in gold through gold mutual funds because whatever gain you get, you have to fully pay tax on it. A much better alternative will now be sovereign gold bonds. It was already attractive, but now more so. Sovereign gold bonds will give you all the gold price appreciation. Additionally, it will give you 2.5% interest income every year. Most importantly, after 8 years of holding a sovereign gold bond, the entire capital gain is exempt from tax. That's a very big advantage. So any investor looking to invest in gold for long term, the most logical approach is now through a sovereign gold bond. International funds, which means the funds that invest in US equity, etc., will also lose this indexation benefit because US equity is not domestic shares in India, right? So again, all these categories also get affected by these change in regulations. Same with multi-asset funds, which invest in different asset classes. You have conservative hybrid funds where debt component is much larger. Equity component is about 15-20%. Because it is less than 35, they are also going to be affected by this amendment. There is only one category largely which is now existing where your equity component is more than 35% but less than 65%, because more than 65% equity is anyways equity funds. That was a category existing before and that will continue, but this new category has emerged somewhere in this 35 to 65% equity bracket. There is something called as balanced hybrid funds you will get, where debt component could be something like 40-50%, equity could be something like close to 50%. So a 50-50 debt equity portfolio will still continue to be taxed like earlier, where more than 3 years gain will be long-term capital gain, and you will end up having an indexation benefit also. So that's a very important category going forward. Any mutual fund house which does not have a scheme in this category will create one, because this is a category which now has that tax benefit continuing. More than 65% equity in any portfolio is an equity fund, which means the taxation will work like equity. No change has been done in that particular type of schemes. There, the returns are going to be taxed in the same way. More than 1 year is long-term capital gain. It will be taxed at 10%, no indexation logic. And less than 1 year is also concessional, only 15%, which is much lower than your normal income tax rates you pay as per slab. So this is how the changes have been done to various categories. Now, does it mean that debt funds are dead? Does it mean that we should not invest in it? To be honest, I don't think so. The tax advantage due to indexation that was relating to debt funds that was available was more an icing on the cake. It does not mean that the product itself is not useful now. The cake also is extremely useful. I mean, in other words, why am I saying so? Because there are a lot of advantages that debt fund still has over the fixed deposits, notwithstanding the amendment. First is in debt funds, you only pay tax when you redeem the money. So you held it for many years. Only when you redeem, only when you realize that profit, you will end up paying tax. FDs don't work like that. FDs have something called as accrual-based taxation. So even if you hold an FD for 5 years, you don't take any interest, you're letting it accumulate. The tax law says that every year's interest will still be calculated. You haven't received it yet. You have to pay tax as per your slab rate. So in debt funds, you can postpone the tax impact till the time you're actually redeeming it. Also in debt funds, there is no tax deducted at source. Mutual funds will not deduct any tax. FDs will continue to do so. You will have the benefit of offsetting some other capital losses with this short-term capital gain from debt funds. So it is still under capital gain head, this income from debt fund, not income from other sources like FD interest. So because it is in capital gain head, you can offset some capital loss also, which can be useful to reduce your taxation and do some, tax harvesting, etc. Mutual funds have very high liquidity, which means that there is no need for you to hold on to the original agreed tenor of the fund. So if you invested in a mutual fund for 5 years, and for whatever reason you want to take the money back in 6 months, it is available. You can get the money in a day or two. There is no issues with liquidity. In FD, on the other hand, if you break the FD, if you redeem it before the original maturity, the bank will say, you know what, this is not what we had agreed for. So I will not give you the original interest agreed. I'll probably pay you less. So there is actually more liquidity at any given point in time in debt funds, which is very important. If you ignore all these transactional things, debt funds has a lot of advantage from a choice point of view also. I mean, in FD, you're still investing for a specific tenor and earning a particular rate of interest. In debt funds, you get different category of schemes. You have something called as, let's say, dynamic bond fund, where you can actually earn from the interest rate fluctuations, and a good skilled fund manager can give you alpha over FDs in this kind of category. Credit risk funds is another category where if the fund is managed well, your gross returns itself can be a percent or two higher than FDs. Post-tax, you will still have that difference because the gross itself is higher. So there are a lot of options available on the debt fund side, which I think is still very attractive to be considered for sophisticated investors, for investors who are willing to take a little bit of an extra risk on the credit side. We have a category called banking and PSU debt fund, right? So you can, without taking much credit risk, invest in bonds and fixed income securities issued by banks and PSU companies and earn maybe a percent or two extra as compared to the FD. So there's a lot of advantage still available from a choice point of view. And in certain phases of fixed income cycles, like we are currently in a cycle like that, when interest rates are going to peak over the next 2 to 3 years, if interest rates soften, in debt mutual funds, you can earn a capital gain component also. That can be very, very useful because your returns can actually become higher because of capital appreciation. So all that advantage, I think, still will make debt funds more attractive than fixed deposits. What are the other thoughts that we have? In debt funds, as I said, there are usually two components of returns we used to get. One is the interest accrual or coupon, and then there was this capital gain component also. Now, everything is now going to be treated like interest, which means that what the amendment is saying, all the returns you're getting is as good as interest. I am not going to differentiate. The tax law is not going to differentiate between accrual income and the capital gain that you got because of the interest rate risk you took. There is no difference now. Everything is as good as interest. There will be a payout plan also that mutual funds will obviously now be keeping active. Earlier, we used to invest in growth. Now you can invest in the payout plan. Same taxation now. The biggest impact, please remember, is for those investors who are in that 30% tax bracket. Because if you're in a 10% tax bracket or a 20% tax bracket, your taxation impact is the same. Because if you take out the indexation benefit also, you're anyways paying 10% as per your slab rate or 20%. So there is no impact for you. But if there is an investor who is at a 30% tax bracket, if you are one of them, then yes, you will have an impact because earlier you were paying 20% tax with indexation. Now you're actually paying 30% without any indexation. So there will be, as I showed you in calculation, a decent impact from a taxation point of view. As I said, I think debt funds are still very attractive, even if the taxation norms have been changed. One category that could be used from a fixed income returns point of view is going to be arbitrage funds. You will see a lot of demand for arbitrage funds now, but please remember arbitrage as a concept which uses cash and futures in derivatives market, is subject to a lot of liquidity and opportunities, which means that it is possible that arbitrage funds may actually give lesser returns than fixed deposits or debt mutual funds at a gross level. So opportunistically, arbitrage funds could be better than FDs, but again, you have to see the timing of it in a significant way. What I significantly is going to see and what I expect is that listed bonds will get a lot of demand. Listed bonds, which means you're talking about bonds that are listed in the market. Also, unlisted bonds will be in demand because in both cases, if you buy a bond directly, whether it is listed or not, the taxation is much better in that sense. So you will have a demand for bonds. It was always the case earlier, but there are two problems with the logistical side of real markets that we see. One is liquidity. When you actually go to try and buy these bonds and sell these bonds in the open market, liquidity is not very high. Second is ticket size. In many cases, if you want liquidity, there are brokers and platforms available through whom you can buy and sell these bonds, but the ticket size could be higher at 10 lakhs or 25 lakhs or 50 lakhs in some cases. So wherever possible and available, listed bonds and unlisted bonds will definitely be a better option. What should you do if you are confused about that part? Not much. I mean, if your investment plan is set and you anyways have a plan made to invest your money, you stick to that. There is no need to change anything. Just because of the change in taxation, you should not change your investment plan in a long-term wealth creation journey. However, as a part of your investment plan, like at House of Alpha, we do have it. If there are some allocation that you're making to debt funds, then it is better to invest before 31st March because any investment that you make will still have that indexation benefit. Post 1st April, you will lose it. So over the next 4 or 5 days, you can think about, do I need to allocate some money into these debt funds or other categories which has got affected by this change in tax? If yes, try to allocate those funds earlier before other normal equity funds. Complete your investment before 31st March and then go back to your normal investment plan that you have. So that's the only thing you should do. I hope this was helpful in clarifying some of your questions. Thank you so much.